The periodic table of investment returns shows that there is no clear pattern to the winners or losers in each asset class. So rather than investing in one particular asset class or one individual stock, a much better strategy is to stay diversified by having a portfolio that includes both higher risk assets, such as stocks, and lower risk assets, such as bonds. But what exactly do we mean when we talk about diversified investments? Diversification is a strategy that mixes a wide variety of investments within a portfolio to maximize returns and limit exposure to any single asset or risk. Consider that if you only owned one stock and that company went out of business, you would lose that invested money. When you diversify, this doesn't happen, because if one investment fails, you have lots of others that can reduce or completely cover your losses with their gains. Take the example of two of the main asset classes, stocks and bonds. Stocks and bonds move in opposite directions given similar economic conditions. In other words, they tend to do well at different times. One zigs while the other zags. So having a combination of the two can help to make your investment journey smoother without sacrificing returns. Another way you can diversify is geographically. American investors instinctively prefer to invest in U.S. companies. It's what's known in the industry as home bias. But your portfolio should also include stocks from other countries. You can also diversify within each asset class. With stocks, for example, by investing in lots of different companies across a variety of industry sectors, you give yourself greater potential for growth because your success is not dependent on any one investment. If you have a diversified portfolio, in a given year, you will own both the best performing asset class as well as the worst. So, compared against the single best performing asset class in a given year, your diversified portfolio will lose. However, over time, a diversified portfolio will always beat any single asset class, because as we can see from the periodic table of investment returns, the performance of asset classes go up and down from year to year. To illustrate the importance of diversification, we can look at the 10-year run of the S&P 500 from 2000 to 2009. If you had invested $1 in the S&P 500 in January 2000, you would have had 91 cents in December 2009. For investors in the S&P 500 who did not diversify, it was a lost decade, with a negative return of 9.1%. But during the same period, the return for emerging markets was 181%. While it was more volatile, over 10 years, the long-term returns were much greater. This demonstrates what over 70 years of academic research has shown, that by diversifying and investing in a range of different asset classes, you can manage risk while increasing portfolio returns. Our next video will talk about how to approach building your portfolio.